Hello, everyone, and welcome to our K-1 Pass-Through Entity Series. I'm Dave Stauffacher, the Senior Credit Trainer here with Lenders Online Training, where we help lending and credit professionals say yes to good loans. My colleague and fellow Senior Credit Trainer with Lenders Online Training, Joe Davis, is here today. Thanks for joining me, Joe.
Thanks for having me, David. Great to be here.
Awesome. Joe, we have yet another question in this series from our viewers. And, this one's definitely interesting. Not that the other ones weren't, but it's caught me a little bit off guard, kind of a deeper thought. The question that was submitted here, let me see if I got it. When can I use assets in addition to income when determining if I can make a loan to a high net worth individual? Assets. Probably he means investments, maybe something non-operating activities, maybe it's retirement portfolios. I mean, if I remember, Joe, I thought we've had some questions like this dealing with high net worth individuals. I mean, I know they're complex. I mean, financial portfolios, they have oftentimes their taxes are a little bit lower because of some CPA strategies, but they have lots of assets. So are there different rules involved again with the high net worth individuals?
Yeah, and I agree with you, David. This is kind of a recurring theme, but the point is that this comes up a lot, right? We're all cash flow lenders. We all fancy ourselves cash flow lenders. That's what we place the most weight on, which makes sense because that's what's going to repay our loan. So the thought is, okay, well, gosh, what if that's a little light, but they have a big PFS? How do I want to look at that? And what I would say is the guidelines are determined by the bank or the credit union, the institution. And that's really based on the type of lending they do, the types of borrowers that they have. For Lenders Online Training, for our clients who work primarily with high income, high net worth individual borrowers, we often see a willingness to consider assets that are liquid, in addition to the historical cash flows that they've received from the liquidation of those assets. And this is also on top of kind of the regular income that they have, other income producing activities such as wages, maybe rental income. They have probably Schedule E entities that they're getting distributions and withdrawals from. So should we consider those assets as well? That said, I have no problem applying this idea to anyone with significant liquid assets, not just quote unquote wealthy people. If they have liquid assets that are readily convertible to cash, I think you should take a look at that. I'm thinking of folks perhaps in or near retirement who have amassed a really nice portfolio over the years, nice portfolio of stocks and bonds that they plan to and can tap in retirement. Now, what I will say, though, is be a little careful of that, because it's important to remember that if funds are held in retirement or in trust, they are insulated from the bank in a liquidation scenario. So in other words, the individual can touch them if they want. They can liquidate them. They can sell them to repay our loan, but we as a bank cannot. It's protected. So I think people need to keep that in mind as well. So, Dave, let's talk about when we might feel the need to use those assets in our credit decisions.
Okay, great point on that. I mean, I would think that if I'm dealing with an individual that maybe is not bringing a lot of cash flow to the table that we can see. You mentioned before, some people might be in their retirement years where they get some Social Security, they get some income. But if I looked over the last couple of years, it isn't significant, and they've focusing on liquidating some assets. Then I might consider this. Now, this, of course, is a guideline question. We've talked about this before in Lenders Online Training. We don't set the guidelines. However, we do have some experience with many of the institutions that we work with, and they have a lot of things set with guidelines. Matter of fact, in your career, Joe, you kind of were responsible for setting some guidelines. So in all those situations, I can remember there's always flexibility involved. Let me think of it this way. It's kind of like an asset-based lending approach. Seems strange, but an asset-based lending approach where the assets are they're the securities, retirement accounts, somewhat converted over time into a monthly income stream. Let's say if I think in the past, what I would used to do is I looked at their portfolio as a whole. I would see it from year to year. I would then probably do a minor calculation there and divide it by 360, assuming I was amortizing it over 30 years like a mortgage. And that would give me a little bit of an idea on the monthly income that I think could be available. Now, that may change year to year based on the portfolio, but I looked at their assets as something that could be converted, and I kind of knew about it. And of course, I documented it as well. So, but of course, we got to consider, if we're considering that, we're going to need to pledge those assets in some capacity. Retirement accounts you mentioned before, that's a problem. But if we know that they have a whole Stark portfolio, that may change. So we as lenders, we need to understand that we need to pledge those securities in some fact, and that we kind of are doing our due diligence to mitigate the risk to the bank. Matter of fact, in one of our case studies, actually one of our case studies this week, we talked with our credit and lending professionals and talked to them about their guidelines, talked to them in situations where this might be pushing it a little bit. This is what to maybe consider. So give them the confidence that if they do have some of their questions, they reach out to their person, maybe it's their superior, they talk to the head and say, I've got a question. I understand what our guidelines are. Here's some situations. This is how I'm analyzing it. This is how I'm breaking it down. And try to push for an understanding. Is the guidelines hard and fast, or is there some flexibility? Is there some flexibility because of the relationship we have? So I think in general, all these questions that we focused on gives some gray area to conversation. And this is why we've always kind of focused on our tagline that we're here to say yes to good loans, helping professionals understand the context of what's going on, but what's right for not only the borrower, but what's right for our institution. There may be reasons to understand that. Any follow-up, Joe?
Yeah, I really like what you said about guidelines, David. And when I was writing or reviewing or altering loan policy, I would try to hit about 90% of the scenarios we're going to see, right? Your policy is a guideline. You can't possibly take all of the endless amounts of deal types and specifics that you're going to see into account. So there's always going to be some judgments. So your guidelines are going to try to hit most of what you're going to see. Things like this are going to pop up and you're going to say, oh, the DTI doesn't work or the DSCR doesn't work. But gosh, look at this big PFS. Don't know how you'd ever capture that really, truly in a formal loan policy. So judgment calls always come into play. So I really like what you're saying about that. And I would add, I think it's really important to verify those liquid assets if the underwriter is placing a significant amount of weight on them. You can request bank statements, brokerage statements, and actually see what assets they're holding. I think you would feel different about a portfolio of blue chip stocks and bonds versus a portfolio centered in cryptocurrency. You know I sure would. So I want to see what's in there. What are the assets? How much weight can I place on them, right? And then number two, you can also see who owns the assets. You know, a PFS says, oh, these are my assets. Well, are they? Or are they in retirement? Are they in a trust? Are they held jointly with your spouse? Are they actually your company's liquid assets and you're calling them liquid for yourself? I've seen all of those and everything in between. So it's really important to see what kind of assets they are and what entity actually owns them, because you're absolutely going to want that information for your underwriting. This is also a really good way to paper the file for your examiners. They want to see that you're doing this due diligence. Don't just take the PFS at face value. They want to see these types of things in file. They'll be very happy about that. And while we don't underwrite for the examiners, know that they play a very important role in what we're doing. And finally, I really like what you said about perhaps pledging those assets. Maybe you're taking them as collateral as the bank or credit union if you're placing significant weight on them. But if you're not, maybe you don't feel like you need them, but you're still relying on them. Maybe you can place a loan covenant on the loan that says, hey, you have to maintain a base level of liquid assets for the life of the loan. And that's a good way to protect yourself. It's ensuring they have some dry powder if and when you ever need it. So just a few more thoughts on top of what you laid out there, David.
I love it, Joe. I'm going to think this is going to be a Joeism. Love it for paper the file. That's a new Joeism. We're going to have to keep track of these. Hashtag paper the file.
I'm going to get a t-shirt.
Yes. There you have it, everyone. When can I use assets in addition to income when I'm dealing and determining if I can make a loan to high net worth individuals? Now, I realize today's session was probably a little bit on guidelines as well as documentation recommendations rather than specifically K-1 discussions. But I think that can happen when you're dealing with a few seasoned veterans like Joe and myself when it comes to credit standards. So I hope you all appreciate that. Now, if you want to need a further understanding of how K-1s enter the picture from each type of entity, I suggest that you follow our live streams because we've had great topic discussions on each one of those areas. You would also check out with Lenders Online training for our foundational training, where we hope to gain some confidence in your team, whether it's the individual underwriters or the team in general. Look forward to an opportunity maybe to talk to us if you have any questions. I would recommend you reach out to lendersonlinetraining.com/talk. We'd love to be able to chat with you. I know you've heard this before. I do appreciate all the questions and comments that you do. Like today's question, it was a little bit deeper in thought, and we appreciate the opportunity for us to just chat. I love the conversations. So I ask you, let's continue the conversations. Send us what's on your mind. From today, I wish you the best. Until next time, take care, everybody.
So long.